Before we start, I'd like to acknowledge the traditional owners of the land on which, lands plural, on which we're all meeting today. I pay my respect to the elders past, present, and future, and any Aboriginal elders who may be here today. Cameron Murray joins us today. He is, he's a research fellow in the Henry Halloran Trust at the University of Sydney. His expertise covers housing and property markets, public finance, resource and environmental economics, and corruption. He's the co-author of the popular book on Australian political favourism, Game of Mates, How Favours Bleed the Nation. And Cameron's coming to talk to us today about his anti-zoning perspective, which I think is very timely given the wave of supply side reform enthusiasm from the Productivity Commission, the New South Wales Productivity Commission, and also just recently the Australian government announced an inquiry into supply side challenges in the housing market. So it's very timely, and I'm very much looking forward to Cameron's presentation. So without much ado, I'll pass over to you, Cameron.
Thanks, Gerard, and I'll just tell you when to click through the slides. We're just operating in tandem here. I couldn't share my screen. Yeah, this is probably even more timely than you think, because not only in Australia do we have these various supply reviews and inquiries, there's one going on in the UK again. After one in 2012 and 2017, there's another one, and they call it the build-out rate. Why is supply so slow? In the US, the debate is going crazy. You can see, for example, the San Francisco Chronicle and the New York Times writing sort of collective editorials from their staff saying, this is the biggest issue in the world today. We got to do something about zoning. So I'm going to try and offer you a different perspective. So I didn't say I'm pro-zoning. What I am is anti-zoning. Like I'm against this free-for-all anti-zoning claim that is packaged up with this idea that removing limits on housing density will radically change the rate of supply and radically reduce the price of housing assets and housing rents. That's the anti-zoning claim, and I'm anti that. Okay, so let's click through. So what's the plan today? I'm going to try and sort of outline my alternative view. Well, I'm not going to say it's an alternative view. I think it's the correct view, because I think the anti-zoning movement has become very detached from the reality of property markets, and I want to bring it back. And I mean, I'm pro-zoning in the way that I'm pro-planning, and I'm pro-density, and I'm pro-coordination of our cities, and I'm pro-investing in infrastructure. But what's happened is the movement has really become detached from what planning and zoning can and can't do for the housing market. So what are we going to talk about? The big shift is property as an asset. We're not talking about corn or wheat or your fruit crop here. We're talking about assets and property prices as an asset price. And the important element there is that undeveloped land is also an asset, and cash is also an asset. And when you swap them, all you do is swap two different assets. There's no sort of deteriorating crop that you've got to clear the market with and before your next crop comes along. The second concept is that density, the dwellings per unit land, and supply, new dwellings per period of time, are totally conceptually distinct and mostly unrelated. So we have embedded in our idea this conflation. The word supply comes with all this extra baggage, but the number of dwellings on a piece of land is not the same as the number of new dwellings across all possible sites, and I'll show you why that is important. The equilibrium in this market is a dynamic one, not a static one, which is why density and supply are different, because not every building that could possibly be built has to be built all in one period. And I'll point out some contradictions of the political economy, and sort of where do we go from here? And I suggest we look at the history of what we did in housing markets for the lessons we want. So let's go through. Next slide. So I guess in terms of the whole idea of property as an asset, the first thing we've got to understand is, well, what's the price of the consumer good of housing that we seem to want to care about? So, because we don't say, oh, the price of Apple company stocks is too high. We go, well, is this phone affordable, right? Or is the price coming down? You know, so we recognize that an asset and a consumer good are different. And so in terms of housing, rent is obviously the consumer price, and it is affected by the quantity of dwellings relative to the demand. But we should expect that the rents rise with incomes, not with the consumer price of other manufactured goods. And why would we expect that? Well, for the economists out there, there's this idea of utility, right? And we substitute our consumption between different types of goods. And most sorts of utility approaches or functions suggest that the optimal thing to do is roughly spend an equal proportion of your income on, or not an equal proportion, but a constant proportion of your income on different alternatives. So in housing, it might be 20% to housing, 10% to food, whatever. And if the price of that good falls, you buy more of it until you've expended that budget share that you've devoted to it. And so in housing, what we see is quite interesting is that pretty much, if we look at this graph from the ABS, the renters with private landlords have spent 20% of their income in 1997 to 1998 and 20% of their income on housing in 2017 to 2018. So over that 20-year period, there was a cycle. So you can see that in the early 2000s, rents fell a little. We had a massive construction boom, and in the early teens, there was an increase. But overall, across the cycle, we would say pretty much people spend a fixed budget share. And so for today's debate, when we think about what's going on in regional towns with all these wealthy people moving out, everyone's puzzled by why rents keep going up. And the reason is because people are bringing incomes into these new locations and bidding up rents to the proportion of their income by trying to outbid each other for the superior spots. So, we used to call that gentrification when rich people moved into inner city suburbs where poor people lived and outbidded them. But now we're sort of seeing the reverse, where the wealthy inner city is moving out to the regions. And that's basically income driven. All right, next slide. And so if we look, therefore, at what we've seen and how the debate's been framed, if planning and zoning affects the stock of housing, then it must have a price effect on the rent, right? But a variation of the price that differentiates itself from the rent, so if prices double and rents are the same, you can't blame that there's not enough dwellings, like a physical dwellings, because people are paying the same amount for them, right? The consumer price is the same. What must be happening is some kind of asset pricing issue. That why are people willing to pay more to buy the asset, that supplies this good where the price of the good is the same? And so I like this graph because I like to say to people, you're lost on not supply mountain. You're looking at asset prices and trying to explain a variation of the asset price from the price of the good by something that only affects the price of the good. Yeah? So you can't actually do this. So you're climbing the wrong mountain. You're looking at the wrong thing. And this has important implications for all those interesting examples that routinely come up, for example, in Houston and Tokyo. Well, Houston's a good example because it's got one of the highest property taxes in any place. And you can certainly affect asset prices by adding a tax liability to them, right? But of course, rents to income are very high in both Houston and in Tokyo. And of course, both of those cities in the 80s had record housing booms that exceeded, Tokyo's was a world record and Houston's was an American record housing boom. So it's a bit hard to therefore then also say that, their supply planning laws stop them from having this asset price explosion when they're both amazing examples of exactly that. So how do we
Cameron,
measure?
just,
Yeah.
just on Houston, there'll be a whole bunch of people in this forum that sort of don't understand the poster child that Houston is.
Oh, really?
Yeah. So from some perspectives, so maybe just rewind a little bit and
Yeah,
tell us
right.
why Houston's a good example. I think it'd be
Oh,
a good context for our participants.
great. So Houston has a single zone for the whole city that basically says build whatever you want as long as you got a car park and a setback. You can put a high rise next to a detached house, next to a commercial office, next to a brothel, next to whatever. And people think that somehow that is, going to lead to great urban density and cheap transport and cheap prices. Yet the evidence there is that Houston is basically the same as everywhere else. And the reason that their asset prices, the price of their housing, is much lower than comparable dwellings in other major cities is because they have taxes of sort of 2 to 3 to 4% of the total property value. So if you buy $1 million house in Houston, you might end up paying $30,000 in property taxes in a year. So obviously, you're willing to pay less in those areas. So I suggest if you want to get onto the Houston thing, if you're on social media and the economic blogs in the last 10 years, that's where you'll find the debate, and possibly on Twitter these days as well. So that's where the example comes from. So that's one example. Other people talk about Tokyo because Tokyo asset prices have been very stable for a long time since the big crash. But of course, that's true in a lot of places like Perth where they've had a big crash and, we're 6 or 7 years later and prices aren't doing anything despite the East Coast booming. So there's a bit of baggage in the Houston and Tokyo examples.
Cheers.
All right, let's go on. Thanks, Patrick. Next slide. And the reason to focus on this differentiation of the asset price and the price of the housing good is because we've been in a 30-year period of declining interest rates. And of course, when interest rates fall, you're willing to pay more for an asset that gives you the same income flow, right? Because your alternative investment options, holding cash, gives you less and less and less. So here's a bit of an example for you. So the grey line along the bottom is the income growth since 1980. And the orange line is the dwelling price that is serviceable with 25% of that income for a 70% mortgage. And it grows above that income growth, which is roughly rental growth, if we recall, by an astronomical amount. And that gap, that shaded blue area, is all asset pricing. And most of that is the decline in interest rates. And so what we can see is that the actual dwelling price in the blue kind of tracks that orange line, but it does so in cycles. So for example, in the early 2000s, you can see the price get quite high above what is justified by the interest rates and the rents, for example. And we can see then after the financial crisis, they converged from a product of falling rents, although rents didn't fall particularly for long then, they then rose in 2010 and 11, and declining asset prices, and those lines got close together, and then we can see them diverge again. And so in sort of 2017, we saw a divergence, but then since then, the decline in interest rates once more has actually got the orange line up to the blue line. So essentially what that's saying is that what's another way of saying it? Another way of saying a similar thing is that the price of renting a dwelling and the price of renting money to buy the dwelling, which are substitute ways to occupy a dwelling, stay together very closely over the long run. Yeah. So, and the way this cost of the mortgage adjusts is by prices going up. So interest rates fall, prices go up. And so that's what we've seen. And so about this time, it was May last year, when everyone was panicking about COVID and the next depression and house prices falling 30%, I went on a podcast and I said, guys, you're missing the asset market here. prices are much more likely to rise 20% than fall 20% in the next 12 months. If you bet against that, you're going to lose money. And of course, I was called crazy. People online, I mean, you know, the insults were flying. And of course, I was on the right side of history, but no one cares now. No one checks back. And that's because interest rates halve. So if interest rates halve, you can double the amount you borrow and still pay the same rent for the money as you would have previously, right? So you can borrow a lot more money and pay the same interest. And interest and rent are essentially substitutes. All right, let's move on. Next one. So housing is an asset. That also sort of implies that undeveloped land is an asset. And now, of course, land in a lower value use is often in a use and generating a rent, right? But not always. You can have vacant land, and if you look around your city, you'll find a lot of vacant lots or lots that are used for car parks that have been there for a long time. And the question is, well, why? What sort of asset market allows for these economic opportunities to sit there? You know, it's money on the ground, wasted. And the answer is that because property is an asset, undeveloped land earns a return via capital growth, even without development, because its value is the value of the option to develop. So whoever buys it has the option to develop, and they can earn that residual rent. So just like a company share has a value, it's the residual after the company earns its income, pays its cost, and the share owners gets what's left. The value of an undeveloped land is the same. It's what's left over if you made those capital investments, got those revenues from development. The leftover bit's what you get for that land. And the thing is, its value grows, and so capital growth is an economic return just like any other, right? I mean, you can generate income and then buy a property asset, and now you've got a higher valued property asset in your portfolio, or you can just have one property asset that grows in value, and the net effect is the same on your balance sheet. So you don't have to develop to earn this economic return, and we can observe this graph here is from Lendlease's annual reports that they manage an enormous land bank of 53,000 apartment units. So they own sites that are zoned for 53,000 apartments, but they don't want to build 53,000 apartments. They only want to build 1,000 to 2,000 per year, depending on market conditions. So what are they doing? Sitting on these expensive assets, right? If these were an inventory, the directors should be shot for being irresponsible with their money and wasting all this money on this excess inventory, but they're not. And they explain that they manage these land banks like capital assets, and they drip feed them, and they go and get approvals for new density, and they invest in neighbouring areas if they have master planned communities to ensure that they get the most value when they decide to develop. So
are they definitely owned, Cameron? They're not options on those, that residual potential?
Good question. I'll check. I'm pretty sure these are owned for Lendlease because they're on there as billions on the balance sheet.
You would think so, wouldn't you? Yeah. Anyway, you could to confirm that.
But there's certainly a lot of smaller players around who have a lot of options sitting there, and they have a value as well, right? Because if you've got an option to buy at this price and the market price moves, you get the gap, right? So again, you're not in a hurry, because here's the thing. Oh, well, I'm going to get to it. Let's click through. So this is sort of an important distinction. Yeah, so we're talking about this land value as the residual, right? So if you look on the left, this is the sort of the block, the before is before a market price change in the dwellings that you could build on a site, and that vertical height of the bar is the total revenue. All those grey sections are the cost that you need to incur to develop and get that revenue, and the bit that's left over is what the land value is. And so if the market price is rising, but those costs are the same, then your land value, that red block on the bottom, is rising, and so you're getting that capital value. Does that make sense? And this is also the same logic at play, comes into the political debate about developer contributions and charges on development and so forth, because these get subtracted from their land value for all those owners of undeveloped sites, because it's an additional cost that you need to incur to get that revenue. Because the value of your site is the residual, you're taking the economic hit. It's not something you can just add on and change the market price in your area just because you got this extra cost. I mean, you can't just add on costs, otherwise no one could go broke in this market. If I get a parking ticket when I visit the site, I can't just go, whoop, I'll just add it to the cost. So that's true for all of them. And this is why landowners complain about developer charges or contributions, but they like to use a different story, which is, no, we're going to add this onto the price and it's bad for everybody else. We're just nice guys. It's not going to hurt us. We'll just add it to the price. You guys will suffer. So that's important to keep in mind for that debate. So let's just try and now get to the logic of what developing does. So can we click through? So this is quite interesting, because these quotes on the left are what developers have said in surveys, in various surveys. In a buoyant market, or summaries of what they've said. Developers are willing to put prices up as far as they possibly can. If you're in an area with little or no new housing, you have to throttle new product. Developing all homes simultaneously would reduce sales prices. The market can bear a certain price at a certain volume. There is no immediate point at which you would oversupply a local market with new build properties and consequently reduce prices. What's my point here? My point here is that we can't assume in the back of our minds that we're in some kind of hyper-competitive, perfect competition economic world where developers don't know that to sell faster, they have to reduce their prices. We're not in that sort of world. We're in a world where we know that if we flood the market too quickly, we're going to reduce our return. So we have to optimally sequence our development over time. There's an optimal sequence of sales. Is it 2 this year, 3 next year, 4 the year after, or monthly? Or is it 7 this month and none next month and then 3? Well, we respond to market conditions. And if the market's thick, as if there's a lot of buyers, and if the market's rising, actually they're willing to pay more and more each period, then we sell more quickly. And when the market falls, we sell more slowly. And that generates this optimal sequence of sales to maximize the present value of that red square, that residual land value. And that's exactly what developers say. And here's just a sort of summary of other developers to show that land banking, or that stock of undeveloped land that Lendlease had in that last graph, was not unusual. Here's the top 8 listed housing developers. Here's Stockland with 67,000 lots that it owns, and it's only selling about 5,000 a year. And we've got PET with 44,000, and they're only selling 2,000 a year. And that 2,000 is not a rate that comes from the capacity in the construction sector or infrastructure. It responds to the market, because if the market's hot, you will pre-sell earlier. You know what I mean? And if it's slow, you will sell later. That's where the variation comes in. All right, let's click through, because I'm going to try and...
Can I ask a question there? Why don't developers compete? You can probably say the same of many other markets.
Yeah. Well, I mean, here's the question. Why don't all people who own Apple shares suddenly panic and sell all at once and crash the market? I mean, it's the same thing, right? You're just a whole bunch of asset owners. We do actually see sometimes that happens. Everyone panics and wants to sell this one asset all at once. Whether it's in share markets or property markets. But, my logic is this: the property system, as in the way we've subdivided the 3-dimensional space of the earth, is a monopoly. You cannot compete in that system without first buying your little piece of 3-dimensional space from someone who already owns it. Just like I can't compete in the market for Apple shares unless I first buy an Apple share off someone who already owns it. It's the same is true for property, right? There's a finite amount of space, and if you give away more space through rezoning, for example, then the person who already owns space now owns more space. And if they didn't have an incentive to flood the market before, you've just given them more Apple shares. They don't need to flood the market. It's the same sort of logic. So the property system, and so there's an idea that doesn't get much airplay, and that's that where there's no free entry from outside the system, a market will get to the monopoly outcome through trial and error very quickly. Unless you can compete in a market without using the output of that market, right? Then you will very quickly converge to the monopoly outcome. This is actually an idea from biology that actually gets into economics. So you can think about what if someone did, okay, what if one of these developers said, oh, I'm worried about new supply because someone rezoned my neighbors. I'll quickly sell. Well, the neighbor can just quickly buy what you're selling and then become the monopolist in your area, right? It's just money. You're just swapping assets. Why would I quickly sell if my neighbors finds it optimal to buy, right? If it's good to buy, it's good to sell. If it's, you know what I mean? If it's a good buy, I should have kept it, right? So that's the way I see it. And so that's why I like to take the focus from planning and say, hey, look, the market, this is how the market works. Like for centuries before we invented planning, the market had boom and bust cycles. The market created inequality of access to housing and ownership of land, created urban slums in amongst, super high wealth. That's what it did. That's what it's always done. And when we get to the end, we'll talk about the lessons from history. So that's where my focus is, because I think we're very distracted looking at the planning system when we know, for example, that, well, the divergence of asset prices from rents has essentially been the macroeconomic policy plan for 30 years. Since the early 90s, we've said, well, how are we going to stabilize the macroeconomy? Well, we'll boost housing prices if things take a downturn, and we'll do that via lower interest rates. And the whole world is actually prescribed to this economic approach. And it's a bit unfortunate because it's very hard to then independently function. We can't just put our interest rates up to 6% tomorrow without huge interventions in capital markets. So we're sort of wedged. Anyway, so
Thanks.
where else I'm going to get a bit bogged down here, so you might just have to trust me, but I think you'll get the general gist. So not only when I have undeveloped land do I gain value when the price of the housing goes up, even if I haven't built the housing, right? Not only is that true, if the planning system allows me to build taller and taller as that becomes more optimal because prices rise, and of course we know that the marginal cost of construction rises with densities, okay? So, to build a 50-story building or a 51-story building, that extra story costs a lot more than the average cost per story. That's why even in expensive markets there's sort of a limit to density, even if density is unconstrained, because the construction costs go up more than proportionally than the building area that you get from going higher. So what's the gain from waiting? Well, one gain from waiting is the price growth, but the second component is that you could build more density in the future if the price was higher, and not only get price growth, but an extra density bonus as well. Yeah? Because if I don't build a 5-story building now, prices go up. It might be better to build a 10-story building in 5 years' time when the prices is higher. And so I get even more residual value from doing that. So let me just walk you through this plot. So we'll start with the grey dashed lines. And if we look at the quantity of dwellings per lot on the x-axis, we've got dt, and that's what I'll call the optimal density at time t. And that optimal density is where the market price, pt, is equal to the marginal cost, right? So that gives me the biggest residual value, and that's the orange dotted box there, yeah? So that's the difference between the price and the average cost at the optimal density. That's the biggest area, orange box I can draw by manipulating density along that D line, okay, at that price. So that's the optimal density at PT. Now, if I wait a period and price goes up where PT plus 1 is, if I can't change density, then I now get A, right? I get A in addition because I get that price growth and I build the same density. So now I've got A and C as the residual value, that orange area and the light blue area. That's what my land's worth. But because I can vary density when the price is higher, it's actually optimal for me to build way out at T plus 1. Yeah? Because that's where the price is equal to the marginal cost at this new higher price. So what I get then is I get A plus B minus that half of the orange bit C. And it happens to always be true that that B area, that darker blue that you gain, is always bigger than the bit that you lose out of that half orange square at the bottom, right? So you always get more by increasing your density. So you get A plus B minus C, and C being the bit below the solid line. So that's sort of an additional bonus to delay, right? So not only do you get the price change, you get area A, you also get B minus C if you can vary density, right? Because what you don't want to do is build a 5-story building, price is double, and you turn around and kick yourself because you can't build a 10-story building now and get all that extra profits, right? I've actually worked for a developer when we'd built a 30-story building in the city, and we thought, oh, that's pretty good, during 2003 boom in Australia, in Brisbane. And halfway through construction, we're like, oh no, we should have made this way bigger. The market's super hot, prices are rising. So we put in another application to build a 2-story timber penthouse on top of the roof while we're in construction and just integrate it in because we're already halfway built. But we never got a good design or an approval for it. So that's where the incentive is. You don't want to find yourself in that dilemma. All right, let's move one more slide. So we get this gain from waiting. Now, here's the dilemma. Okay, here's the dilemma. You're a housing developer, you've got a large plot of land on the fringes of a major city with no planning constraints. How quickly should you sell these lots to supply them to the market? That's the question, because remember, housing supply is how quickly something happens, not how densely something's developed. And you sell at a rate where the benefit to selling one more unit in this time period is equal to the benefit of selling it in the next time period. So I'm substituting sort of from the next time period to this time period where the benefits are equal. And that means I've got the exact optimal rate to sell per month or whatever. So it's a dynamic intertemporal equilibrium. And I can try and explain this with the sort of right-hand side term, because what are you actually doing when you sell property? You're swapping an asset called undeveloped land that's on your balance sheet and it has a value for cash on your balance sheet that has a value of equal amount. So it's a balance sheet reallocation from land to cash. I mean, cash is nothing magical about it, right? So you're just swapping these two things. So when should you swap? Well, you should swap when doing so gives you a bigger incremental gain in the next period. That is, if I swapped one more undeveloped lot into cash, then my total balance sheet would grow more than if I kept it in land, because the returns from owning cash for that extra unit are higher. So the interest I'd get on the cash are higher. So let's just quickly walk this through. So what you're doing is you're maximizing this sort of sum. And the sum is the return you get, so how much your balance sheet would grow if you had that quantity of land as cash. So QT is the quantity I'm selling. RT, capital R, is the land value when I sell at this time. And I plus tau is the interest on the cash minus tau, which is the tax that I save from having cash instead of land. So land taxes, for example, that are a proportion of that market value. So if I have high land taxes, then delaying becomes more costly because I have to pay this land tax every time I don't sell this undeveloped land to the market, right? So that's the return I get. I get interest on the cash and I save any taxes on the property. If I sell later though, a Q number in the next period, okay, I get DT star, which is the rate of growth of demand, minus AQ, which is how much selling faster affects the price. And we recall developers just saying that we don't flood the market because it reduces price. So AQT is how much my own supply affects local prices. Yeah. And so the net of that term in brackets is how much the price goes up after I've supplied. Yeah. So it's DT, what I take from the market is the rising demand, minus AQT minus the effect I have on satisfying that demand. And then this little omega, the W, is actually a factor that accounts for what we saw in the previous slide, which is how much you can change density based on a response to price. So if I can change density more easily, so if the flatter that marginal curve, the bigger that omega. So the more gain I get from waiting, because I might be able to sell at a higher density later. All right, let's click through. So what do I end up with? Oh, that's what I just explained. Let's click a couple more through. Yes, so that, just go back to that last one, sorry, with that equation on it. Oh, I didn't put the solution to the equation. Well, that's weird. I'll tell you what the solution is. So the QT that maximizes this term is the instantaneous rate, or the rate per month that I should sell today, given conditions. And if conditions are unchanged, it will be the optimal rate every single period. That maximizes the rate of growth in the value of my balance sheet from the choice of swapping property assets to cash assets. And when you get to it, the interesting thing you find is that the density is irrelevant. Okay, so just because if I can build 100 lots on a big plot or 100 lots on a small plot, the density is much, much more dense, but the optimal rate at which I sell is the same because I'm just trying to optimize with respect to market conditions. And the main factor that comes out of here is the bigger that D star is, that D dot is. So the faster the demand curve is rising vertically, and the thicker the market, so the smaller that A is, the more I sell. So in a rising market, what you find is everyone wants to build or develop, right? Because that's the optimal thing to do. And in a falling market where D star is negative or A is very big, then you don't sell anything. In fact, you could demolish things like Ireland during the market crash when prices were falling dramatically. It's better actually to stop development and even incur some costs of demolishing houses you've already started for a speculative sell. Yeah. So this sort of predicts this pro-cyclical construction response to supply. And the main factors are, well, when demand's rising, you sell. When the market's thick, you sell. And if you are able to delay and get more density in the future, then you sell a little bit slower. So in fact, you can predict that if you capped density in an area, you might find, and not in a neighboring area, that area with the capped density might develop first when there's a boom, because those landowners have less of a gain from delay than the ones in the next suburb where there's no limit on density. They've got more to gain from waiting until prices go up and building taller buildings in the future. And that's something that you can see in the data at times in certain locations. All right, let's click through. We're going to start wrapping up and have some questions. So yeah, so this is what I was trying to explain before. It's best to think of the property system as a monopoly, and that's why, what's the input price to property? Zero, right? It's just there. It's a system we create, just like a taxi license. It's a system we've created to keep people out of certain areas. I mean, I call it, the property system is the first exclusionary zoning system. I mean, that's what it does. The whole point of property is exclusive use. You can kick people out. If you can't, then it's worth zero, because everyone can just show up at your house and live there. We'd call it public property then. So this is a little simulation, this graph of what I did. And what I started was, I had 3 housing suppliers in the market, and they were supplying at what I'd called the competitive market supply, which is, I gave them a supply curve and whatnot. And what I did is I let them experiment with varying their supply up or down and letting the price clear. And what you find is that very, very quickly, through experimentation, those people in the market will get to the monopoly market supply and converge on that simply through trial and error. And now, if you think that this can't happen, this is a quote from the manager of Smith Collective, which is a build-to-rent 1,251 dwellings on the Gold Coast, where residential vacancy is less than 1% and has been for a couple of years. The manager told me that since opening in 2018, the precinct has been on a staged release so as not to flood the rental market, leaving only one empty building left to be released, which will be staged for the middle of next year. And of course, this is late 2020, so middle of next year is now. So we're 3 years into this, and they still haven't rented 1,200 dwellings in a market where there's 500 dwellings, right? So you're 0.2% of the market. You're trying to rent them out, and the optimal thing to do is actually keep half of them vacant for nearly 2 years, right? So there's a real ability to observe your effect on the market, right? The market's not that thick. So that's something.
Cameron, on that, you're talking about build to rent, did you say?
Yeah, so I mean, my point is even more serious, is that you'd think in the rental market, well, you've already built the building, there's no point leaving it empty, but there still is a point to leaving it empty because you don't want to flood the market. And if you read some of the news, go Google New York landlords keeping apartments empty. During this COVID crisis, when everyone left the city, there was a huge amount of people optimally leaving a lot of apartments empty in New York. Why? Because if you rent them today at this price and someone's in there for a year, you can't put the price up on 6 months or 3 months time, right? So if you think this is, you got to, it's the same thing as building a building today and you can't build one tomorrow. If you get a tenant today at this price, and the problem is if you own, a portfolio, everyone's going to want the new lower price as you start accepting it and creating that market price. So there's an incentive, there's an individual and joint incentive to experiment with reducing the supply in the market to maintain prices as high as you can. So that's another example of converging to the monopoly outcome, even in rental markets, even in dwellings that are already built. And if we look to China, actually we'll get there in 2 slides. So let's click one more. So yeah, so this is just a quick one to say that if you are familiar with the classic supply and demand economics, right? The blue line is the demand curve at one period, the orange line is the demand curve at the next period, it moves vertically. What my monopoly view says is not that there's some kind of independent supply curve, but that the incremental change is like a little monopoly. The increment from this year to next year, we're going to act like a little monopoly. And what we're going to do is we're going to take away some of the price gain that would have been there if there was no new supply, but not all of it, right? And where we get to on the equilibrium at T+1 sort of depends on the slope of the demand curve too. So the steeper it is, so the more price sensitive it is, so the fewer buyers at any price, then you will not quite supply so many for the same vertical shift in the supply curve. Yeah, you won't supply as many, you get a slightly higher price change for the same vertical shift. Whereas if you've got a thicker market, a big flat demand curve, you'll supply a lot more and you'll give up some of those gains. So what does this predict? This predicts, for example, when turnover gets lower and lower, that the rate of new supply associated with any sort of change in price will be lower. Yeah, because turnover is a pretty good measure of this thickness, people active in the market. So at the end of the cycle, when turnover is lower but prices are still going up, you'll get lower new supply. All right, that's sort of the type of sort of understanding you get when you get these market dynamics, rather than just saying, oh, it's all zoning. If you rezone, people will panic and flood the market. So the vacancy puzzle is this. Why would anyone keep a developed home vacant? Well, got to ask the question because 1/4 of all dwellings in China are vacant. That's 2.5 times more than Australia. We've got 10% vacant dwellings, which has been pretty constant for 20 years. If you go look at the historical census data, and that's mostly sort of second homes, holiday homes, turnover dwellings in the rental and sales market. So it's, you need that lubrication of the market. Things can't always be perfectly occupied. But in China, it's risen. Not only is it larger, it's sort of risen in a decade from 10% to 25% at the same time that prices have skyrocketed, and they've detached from their rental income. So in China, you'll pay a price where you only get a 1.6% yield. So you're paying for something that rents for $16,000 a year, you'll have to pay $1 million to get it, right? That's the degree of detachment of asset prices from occupying prices. But so what's part of the logic? I'm not going to say it's all of the logic. Part of the answer is that if you think about property as an asset, well, people hold cash, and cash is an asset and gets a really bad return, and shares or an index of some other shares, for example, is an asset and it gets a higher return. So why would anyone have cash? Well, a vacant house is an asset and it gets a return, and an occupied house is an asset and it gets a higher return. Why would anyone have a vacant house? Well, it's just a portfolio problem, right? It's often worth not having the tenant to have a more liquid version of the same asset in your portfolio. Something you can sell at the drop of a hat. You don't have to deal with tenants, you don't have to kick them out, you don't have to give them warnings, you don't have to do anything. So if you own 10 dwellings, it might be worth just keeping one so that you can use that one to time the market. And now if you multiply that by 1 billion people in China, maybe you get closer to this sort of number. I mean, these are constructed and owned dwellings, 25% of them. There's like 700 million dwellings in China, right? So this is an enormous number. Of course, part of the answer could be money laundering and just parking money in assets, because the ownership structure of property is really not subject to as much critique as you would think. All right, a couple more things and we'll get some questions. Sorry, I'm going to push through. If zoning had a large effect on property prices, here's some puzzles. Why don't market prices anticipate rezoning by crashing, right? You could announce, for example, we're going to rezone Sydney for 10-story buildings. And if you had a credible announcement, everyone should panic and crash prices, because you're essentially promising to reduce everyone's prices. Asset markets incorporate that information and everyone sells at a lower price. That's a puzzle. Here's Auckland, where they rezoned, where there's 600,000 existing dwellings, and they've added 1 million dwellings of zone capacity. Can you spot an effect on new dwellings completed per month? Not really. So it was in 2016, end of 2016. There's really no noticeable change. And that's sort of consistent with the view, well, the market's supplying as much as it wants, right? We're in an upward trend in the market, so we're buying more and more, and all we're seeing is the cycle. There's no zoning change. Right, next one. Next slide. A couple more things, yeah. The political economy contradiction. So I think some of you might be aware, I did a study of rezoning in Queensland and found that if you map the political connections of landowners, they hire lobbyists, they're on cross-directorships, they're on boards of the same company, they're related to each other. You can predict which landowners get rezoned and which don't from their political connections. They're extremely successful. And so to sort of say that zoning is constraining housing supply in some way, you're almost saying that developers are politically less powerful than some kind of unresourced grandma who complains about development in her street. You're sort of saying that politicians are more responsive to this than their mates, which I just can't really see a lot of evidence for. In Queensland, we wrote an act of parliament for a property developer in the early 90s and said, you can do whatever you want. You're exempt from all of our planning rules, go nuts. And they're still going 30 years later. Like, these guys are very well connected and very powerful. Even our Prime Minister is a property lobbyist. So are we really pretending that developers can't build housing because there's some kind of political barrier to zoning when they essentially are the government? Essentially, property development is government. at all levels. I mean, in councils, the number of property developers is huge. In the state government, it's huge. They're huge donors, they're huge lobbyists. So it's I find it a huge contradiction. And another little angle of that is that a lot of people argue that individual lot rezonings add value, but mass rezonings decrease it. And then, of course, your question is, well, why does the UDIA or the PCA or the other lobby groups risk asking for mass rezoning if that's going to destroy value and crash markets? All right, next one, and I'll wrap up. The lessons from history. So we have this really weird situation, and this is very common in economics, is that we look to the sort of post-war period and compare it with this sort of liberal period after the 80s, the sort of socialist nation-building post-war period, and this new sort of free market international trade period. And we sort of assume that the outcomes we got in that post-war period were market outcomes, and what we're getting now is some kind of like, oh, markets aren't working for some reason. Whereas it's in fact the opposite. If you go back a century, okay, we had terrible inequality problems, terribly unequal access to housing. It was, Progress and Poverty, written by Henry Jordan, is essentially the most popular book in the world for 20 years, complaining about this and offering solutions. And so the question, I would say, well, markets have never panicked and delivered cheap things for people, cheap assets before. And if we're looking at periods of time in history where we did have cheaper or more affordable housing or rising home ownership, what happened? Well, we built a lot of homes publicly and we just gave them to people for cheap. That's the answer. All right. So if you look here on the left, the orange line is the net share of new housing supply from the public dwellings, and the blue line is the gross, and that difference is the sale of publicly built housing to the private owners. So it was up over 25% of new housing was publicly built or financed. And we had this huge period of selling these public dwellings to private owners. We reached a record home ownership rate of 71% in the mid to late 60s, after it's starting at like 30 or 40% after the Second World War. So we basically got home ownership up by 50% by doing this sort of thing. And now home ownership's down around 63% or something like that. So it's gradually gone down. And on the right here is the UK, where the blue bars are the new housing from local authorities and the green bars are the private new dwellings. And you can see the same thing after the post-war period, a massive, massive effort from the public to directly build new housing. It wasn't the market should just fix everyone, guys, remove zoning rules and all those returned soldiers will get cheap houses. What? No, we just built them. Same way we get submarines. We don't go, if the market is allowed to build submarines, we'll probably get submarines. No, you have to get money and pay someone to produce it. It's a build to order thing, right? Housing is build to order. No one builds it unless someone shows up with money to buy it. Right.
And the long run average for private housing, pretty stable, actually.
Yeah, it's surprisingly stable. Of course, there's a little bit of intertemporal displacement from the war and different sort of demographics going on as well. So that's sort of where I'll leave you with. I'm anti-zoning because I don't think it's just the market has a natural built-in speed limit, and we're not going to change that by changing the density of dwellings. It's called the absorption rate, okay? So that's the built-in speed limit. We can't manipulate that by changing density to any degree. We should certainly allow zoning to be updated and increase density and use it to coordinate infrastructure investments in the city. And that's great. That's what we should use it for. But we shouldn't sort of overreach and say, for example, Peter Tulip's analysis using Ed Glacer's method about the zoning tax, where zoning tax adds $400,000 to Sydney houses. Well, that's just complete nonsense. Okay, we could make housing cheaper by dealing with it the way we deal with other monopolies. Okay, what do we do in other monopolies? We regulate prices. We create public options. Think about healthcare, where monopoly sort of power is huge. Well, what do? We create a whole public health system in parallel with the private system and say, if you can't be satisfied there, we'll just give it to you. And this bugs me about housing, because if you're homeless, If you get sick, we'll house you in a hospital at $10,000 a night, but we won't just give you somewhere to live the rest of the time. So because we treat it sort of conceptually differently. So that's sort of my conclusion. I'd love to have a chat with everyone. So thank you.
Thanks, Cameron. That's a fantastic and very thought-provoking presentation. We're nearly at 1 o'clock, but if Cameron, you're willing to stick around and some people have questions.
Yeah, if you want to stay another 15 minutes, that'd be great.
Yeah, fantastic. I've got plenty, but I've already asked a couple, so maybe I'll open up the floor. Does anyone want to raise their hand or just speak up?
Cameron,
Any other questions?
I've got a few, Jared, but I'm happy to get down
Yeah,
the queue.
go.
I've said a few. Well, a couple of things. One is why are the supply siders just so zombie-like? I mean, what? Like it's you know what I mean? Like they're like robots the way they keep coming back with this stuff, and so that's one question. It's like it seems to me I'm not an economist, and you make enough sense, and I've done enough peripheral reading, and I'm sort of in the debate, and it just seems so. You explain it, all the dimensions of it, but a lot of it is sort of relatively simple. It's like, okay, interest rates, money's cheaper. Of course, you're going to want to go out and spend it, and sort of obvious. Like, so there's this sort of demand side. Anyway, so that's one question. And the other one is, you've reminded me with those last couple of slides on the public expenditure that actually I don't think it'd have that much well, what would be the impact on private prices if we started producing public housing at the rate that we used to? Would it have much of an impact? I don't think it would, like according to, because they're sort of separate things, but maybe.
Okay.
Two questions.
Great questions, because I've put a lot of thought into both of them, and I'll try and be brief. Why the supply side is relentless? I think because if you think it's interest rates, then you have to drop so much other intellectual baggage that you have around what's monetary policy. It's this you've got this nice simple view of the world in your mind. Monetary policy accelerator, blah blah blah. Secondly, because it pays, because property owners are a relatively small group. I mean, property owners of undeveloped land that, lots of people own their own home, but that's a relatively small, powerful group that get all the benefits from zoning changes and planning, right? So they've got a huge incentive to say this. They've got a huge incentive to stoke that story.
Why does that excuse the Reserve Bank economists? I mean, they're just idiotic. Like, what's their agenda?
I think.
I listened to those Reith lectures by Sir Mark Carney, which I thought were great, and even he, in one of the answers to the question, said, "Oh, supply side, oh my god."
Yeah. Well, I mean, there's just 40 years of economic indoctrination. Think about rent control. I don't know if you guys follow me on Twitter, but there's a paper came out on rent control, and it showed that apartments got redeveloped more quickly, so there was more capital investment. People didn't move as much, so they didn't get kicked out so much. There's all these great benefits, and then because rent control is this sort of deep, it's passage one of the Econ Bible, right? People had to then change around and go, actually, no, that's a bad thing. Redevelop. You can overinvest in housing. It must be bad. I'm like, but you just said we'd have declining quality and quantity from rent control. We've shown we've got more quality and quantity, and now it's bad because it's overinvest. You can't have both stories, right? And you find this in housing a lot. People will just say the same thing and go, Peter Tulip does it. He goes, look, well, new supply comes on and it doesn't decrease the price of local houses. Therefore, it doesn't, people should like it. I'm like, but you just told me it doesn't decrease prices. Like, you can't say it decreases prices, therefore we need new supply, and it doesn't decrease the prices, therefore people should support it. Like, you can't have it both ways. So it's just, I think, one of those entrenched belief-driven things. And if you accept that the market has a built-in speed limit, you got to accept that actually we can improve on market outcomes, just like we do in healthcare. And I think that's hard for people to comprehend, because private property and the market is just such a fundamental issue.
So the second one on public housing.
Oh, what was the second thing? I forgot.
Just if we increase the supply of public housing, what would happen?
Oh, yeah. So I have a blog on exactly this question. So, so how I was saying, you can rent the money from the bank, or you can rent the house from the landlord, and those will equilibrate those prices. Yeah.
Yep.
So if you introduce a third option, buy from the public sector, you can introduce it wherever you want, right? And through the movement of people from the private market into that public option, you can equilibrate it. I mean, there can be a gap if you have some kind of quota or qualifying restriction. So, for example, in Singapore, you're allowed to rock up and buy one when you're a citizen at age 30, dwelling from the development board. And once you've got one, you can sell it to the market, and there's a time limit on when you can buy another. So that can keep that gap between the private and the public market. But if you allowed a free-for-all, anyone could do it, then the prices would converge down. But you'd have to supply 99% of new dwellings, I would imagine, to do that. So yeah, you still have to need some kind of quota system, and the existence of that would allow that gap between private rental prices and public housing prices to be sustained, and therefore not have a big effect dragging down private prices. Yeah, so it's certainly, I mean, I think it'll have some effect. Is it measurable? No, but I think it's in the right direction. Yeah.
Mm. Cool.
Marcus, you put a little comment in the chat. Did you want to speak to that one?
Well, it just I think chimes in with what Cameron's just said, that I can remember the Commonwealth State housing agreements of the early 80s, the last of the kind of post-war vision of social housing, but the stated aim was to grow the public housing sector so large at cost rents that it would provide options for anybody, regardless of income. And the stated objective was to tame private sector price movements by growing the large sector. Yeah.
So that's interesting because in the ACT, right, they already have a monopoly supplier of new housing, or at least detached housing, and yet they choose not to. So it's not that it's impossible, but it's a policy choice. And I remember speaking to one of the minister's advisors there. I'm like, they introduced this land rent scheme. They're all puzzled. Why is the house prices going up? What can we do? And when I realized that they had this monopoly public developer, I said, why don't you just flood the market till the prices come down to what you want? He's like, oh, we can't do that because people get upset because their prices go down. I'm like, so you're telling me you can do the same thing through some alternative way, but you can't, you can't actually get the outcome you want. We're all just pretending right here. This is some kind of political game.
The situation back that I was referring to in my comment, it was a slow, long-run strategy to gradually but inexorably grow the social housing sector. It just completely ran into a wall with the Hawke-Keating liberalisation laws, and then we just flipped from one perspective to another. So I think your chart that you showed earlier really revealed that. Yeah.
Yeah.
It also reveals, Cameron, the myth of the zoning being the constraint, doesn't it? Particularly those charts showing the public housing change. I mean, we could double supply with an increase, with the doubling being all public housing, there'd be no constraint to that really.
Yeah, and just look at what happened when we had this home builder grant, right? We just rapidly increased supply because it's build to order. We put in orders, all the builders pulled out all the stops, and I think, went up 60 or 80% in detached housing supply, right? All of a sudden. I'm like, we could have just done that for the last 10 years, but we sort of chose not to. We could have soaked them up. I mean, there are genuine limits, right? Already 6 to 8% of the workforce work in housing construction. So, there are constraints, but you'd think with a bit of demand pressure, there'd be a bit more incentive to innovate and become more efficient with your manpower if you're trying to compete with other sectors. So I think it's ripe for. I proposed last year during COVID. I said now's the time for the government to go and buy undeveloped sites from housing developers who are panicking. If they're half built or they're not, just go and buy all the rest of them off the plan at a discount, take away their risk, and just get your public housing stock going and get them constructing through the downturn. But of course, no one listens to me. And no one wants to solve it, right? People like high prices. 18% of people have investment property. They're the richest group and most politically connected. All property, the average MP owns like 6 investment properties or something like that. So there's not a.
And the Labor Party just yesterday dropped their negative gearing policy to abolish it. But
I mean, our policy is to have high prices, high asset prices. I mean, that's sort of what we want. That's what we're working towards. Every sort of housing strategy, we're good at writing housing strategy documents, but not actually having an institution to implement them or guarantee them. It's just, here's a strategy, the market does whatever it does. Here's a new strategy, the market does whatever it does. And I remember at a housing conference, the MC had all the state housing ministers there and said, you've all written new strategies, but you already had previous strategies. Did you meet them? And if not, what'd you do about it? Or is this just another waste of paper? Something like that. And there's like 10,000 people cheered because they're like, yeah, stop, having us on. You guys, this is not a real commitment. It's just a document.
Cameron, I wanted to go back to something you said kind of earlier on, and Pat, you kind of expand on the Houston example. And you said that, despite having, the single zone, it just looks like a city like any other, and the only reason prices are different is because of the land tax. Yeah, which is a great kind of comparison. I wonder. So that's not. Well, my question from that is, why bother planning if it looks like anywhere else?
Well, I'm not saying physically its layout looks like anywhere else. It actually looks completely different, right? It's just a sprawling mess of everything. The CBD is full of car parks, and the car parking requirement. I'm sold on minimizing car parks. I just don't think cars are efficient for urban density, right? Like, they're not space efficient. So, once you get to a certain urban density, you move beyond cars. It's not like you have no roads. But Houston never sort of got to that point. But yeah, no, if you look at planning works, right? A lot of cities, they've reused industrial, inner city industrial spaces for really good new dense urban spaces and accommodated a lot of extra people and done so in a very coordinated way that integrated with the existing cities. So I think, that's the role of planning, is to coordinate where stuff goes. And if you're building a train, you got to know why you're moving someone from here to here, right? It's got to be part of an overarching idea. So we had an example in Queensland. That's Maha Sinathambe out at Springfield bought this old army base, and no one wanted it because it was in the middle of nowhere. And he lobbied to have this new city he's going to build with 130,000 people. Started building it, realized you can't actually get in and out of it, and then the government said, we'll build you $1 billion rail extension and a 4-lane highway. I'm like, you guys should have thought about that. That's what planning is. It's coordinating those things. Right? We don't even have a train line to the Sunshine Coast, and 5 times more people live up there. So I don't know what. So that's
great. Thank you.
That's where I think the role is, and I think if planners need to sort of, what's the word, sell themselves as coordinators for an efficient investment pipeline, not as what's a good word, like restrictionists or something like that. Is that's the impression you get. And you're in a PR battle with hundreds of billions of dollars on one side and a bunch of planners on the other. And the unfortunate thing is sometimes your interests align, and actually it's a good thing, the type of thing developers want and the type of thing that's good. But a lot of the time you're just, you're costing them money because they want to buy unzoned land because it's cheaper. Anyway.
Great. Thank you. We've gone fair over time. Does anyone have one final question?
Lucky last. I
might leave it there. Thank you, Cameron.
Great.
Really appreciate that. It's been fantastic prezzo and a really great discussion at the end afterwards. Lots of food for thought for us and to inform our work at SGS. So really appreciate your time, and hopefully we'll get you back another time in the future.
Yeah, sounds great. So at the end of those slides, maybe Gerard will circulate. I've got a bunch of papers and reading lists, but look, I'm happy to answer questions via email if you ever this issue ever comes up in your work day to day. This is what I get paid to do: talk about housing supply, absorption rates, and things like that. So it's I'm very, very keen